Hello, everyone. This is Samit Vartak, CIO of SageOne Investment Managers, talking to you from India. Along with Lighthouse Canton, we are running SageOne India Master Growth Fund, and which is mostly specialized in the mid and small cap, emerging opportunities from India. So I am extremely pleased to provide you some insights into what's exactly happening in India, and especially in the mid and small cap space. What are the opportunities? So hopefully, this short video would be useful for you in getting a little more perspective of the changes which are happening on ground in India. It's very difficult to predict what will happen in the short run, but in the long run, Indian markets have delivered the earning, the returns which are pretty close to the nominal GDP growth rate. Right. So today, India's expected real GDP growth rate is about 7 to 8%. Add to that, 5 to 6% of inflation. So the economy is expected to grow at 12 to 13%. So going forward, I expect that the Indian markets should also probably replicate, this kind of returns. And most of the time, the corporate India grows, at least a couple of percentage points beyond the nominal GDP rate. So I expect that Indian markets in the next few years, I think, should deliver the historical average in rupee term around 13 to 14%. Few things that stand out about India is the balance sheet of corporate India, and because most of the investors do focus on the P multiple, which is more PNL related valuation metric. But I think the key changes which have happened, mainly because of the tax cuts that the India has done, as well as through COVID, companies were extremely frugal. There wasn't much help given by the government, at least in terms of dole outs to corporate India as well as the general public. Companies have been very prudent in lowering their working capital cycle, generating cash flow, focusing on the most profitable projects, and hence the growth in cash flow for India has been way higher than the earnings growth. I'll give you a metric, which is the cash flow from operation to net profit ratio for India. Today is at 140%. Historically, it's been around 100%, right? So that 40% jump in cash flow compared to the book profit or the P&L profit has helped the cash flow generation. And after all, the returns are more aligned with the cash flow generation, right? So when you look at the cash flow multiples, whether it's the enterprise value to cash flow from operations, or whether you look at the balance sheet multiple, valuation multiple like price to book, Indian indices are closer to the average multiple. And I believe that the balance sheet and the corporate India fundamentals, which are way above average, are reasonably valued compared to the historical averages because of their fundamental, status today. The biggest improvements, large cap companies in India have always been strong, right? And that's where, they get probably the biggest sort of valuation multiple. But the big change, especially improvement in balance sheet and cash flow, has happened in the mid and small cap space. And by mid cap and small cap space, I mean by, if you exclude the top 100 stocks, the next maybe 400 or 500 stocks is where the biggest improvement has happened. And they have reduced their debt levels. So the debt to equity ratio in the mid cap space, which used to be almost at 0.7 times net debt to equity, has dropped to 0.15 times. And so that improvement in the fundamentals of mid caps is not yet reflected in the valuation. So today, if you look at the top 100 stocks, the median P multiple will be close to, the trailing P multiple will be close to 35 times. Whereas if you look at the next 300 or 400 stocks, the median P multiple there is below 25 times. So that is what makes the mid-cap space much more attractive, because they are, first of all, at discount to the large cap space, and at the same time their fundamentals have significantly improved relatively even, compared to the large caps. I believe that the incentives that the government is giving regarding putting up manufacturing in India, whether it's the domestic or global companies, will definitely help capex oriented sectors, including the building materials which are used in construction of factories, construction of warehouses, construction of infrastructure. So I really like the building material, which is going to be a key beneficiary of the incentive over the next few years. Second sector that I like is real estate, because the inflation, especially salary inflation in the IT sector, has been pretty massive. And generally, whenever the IT salaries increase, it has direct benefit to the real estate sector. So real estate in India has gone through almost 10 years of stagnation, wherein there was inventory built up. It was difficult to sell through any new bookings which are offered, and that has changed in the last year and a half. And today the inventory levels are almost at a 10-year low, as well as the absorption rate of new offerings is at 10-year high. So real estate, I expect it to be doing well over the next few years. And then the export oriented, I like really the API and CRAMS, which are the contract research and manufacturing in pharma, as well as the active pharma ingredients manufacturing in India, because that's a space where I think India will definitely benefit out of the realignment of the supply chain globally, which is happening, where companies would do want to sort of diversify away from the China supply chain. And beyond India, I think there is, there are very few countries where they have such capabilities as well as capacity. So that's the third sector I think India should benefit.